Hello, investors. Welcome back to the channel. What if I told you that you don't need perfect timing? You don't need thousands of dollars, and you don't need to predict the stock market just to become a successful investor. In fact, some of the most consistent long term investors in the world all use the same simple strategy, whether they realize it or not. It's called the dollar cost averaging or DCA, and that is going to be the focus for our video today. I'm going to break it down step by step in a way that any beginner can understand, even if you've never invested a single day before. By the end of today's video, you'll know exactly what dollar cost average is, why it works so well over time, how to use it with stocks, ETF, and even options trading, and how you can start investing without fear, stress, or market timing. So, if you've ever said, I want to invest, but I don't know when to start, this video is for you. Let's go ahead and get right into it. For those of you new here, my name is Tim, and on this channel, I do everything I possibly can in order to help you to push your investments to the next level. For today's video, we're going to be covering dollar cost averaging, which is going to be DCA, which is one of the best investment strategies out there. But right before I go ahead and do that, I'm going to give you a quick portfolio update. So, for those of you new to the channel, I've decided to go ahead and start off a small account portfolio with $65. The reason I invested $65, I want to show investors out there you do not need thousands or millions of dollars in order for you to begin investing. By investing whatever you have right now, it does not even need to be $65. You can and you will be able to make some gains in the market in time. So I went ahead, I started off this channel with $65, and then I made an agreement to go ahead and add $250 on a monthly basis. And then we're going to take that $250 and we're going to allocate it to different stocks. The stocks are going to be over here to the right. I showed different videos of my stock selection, and I'm going to go ahead over the course of this channel to show exactly detailed videos of these stocks and why I decided to add them to my portfolio. Now, a quick portfolio overview. The stock market is open, so the numbers up here is going to be fluctuating just a tad. So we at around $326, and that's only in 1 month. We've only been invested for 1 month now with this portfolio. So for the day, we up around $2 or 0.64, and that could change anytime. However, for the week, we're up around 286 or 89%, as you can see right here. And for the month we've been investing, we're up 53.53% or $1.73. So not bad for a beginner stock portfolio. So we're going to go ahead and jump over to the right here. I'm going to give you an update of what we have here, and then I'm going to get into the dollar cost averaging or DCA and show you how it could help you in order to get better at investing and grow an account portfolio over time. Now, these here is what's known as cryptocurrencies, and as you can see, I have BTC, I have Solana, I have XRP, and Doge. Now, I did mention in my last video, I never went ahead and buy Bitcoin. I'm not big on Bitcoin, although I have it in my big account portfolio. But I did get this free. Robinhood just gave me this, so I'm going to leave it here for now. Now, let's go down to the stocks portfolio. And as you can see, I wanted to make sure I keep this portfolio very, very simple. So I only have 10 stocks in the portfolio. And as you can see here, this is how they're doing. Let me go down so you can see at least the last one right here, which is going to be Oscar. So that's how he's doing. I'm not going to go into a deep dive today because I'm going to save that for another video. Or more specifically, I'm going to save it for the end of the month when I go ahead and add an additional 250 and I allocate it to these portfolio. Now let's go ahead and begin with this video with trying to give a good definition of what dollar cost averaging is. So I'm going to go ahead and start off with the basics. Dollar cost average, also known as DCA, is a strategy where you invest a fixed amount of money at regular intervals regardless of what the market is doing. And for those of you that have been watching the channel for a while, you guys can see that's what I'm doing. I am dollar cost averaging into stocks on a regular basis, and that's what's going to allow me to let the portfolio grow. So you could see Meta right here. I'm going to go down and you should see it right there in the bottom right here. So here is my DCA on Meta. So every month, on the 5th of every month, $25 is going to be going directly to Meta. I don't have to think about it. All emotion is out of this investing. It's just on autopilot right now. So that's pretty much it. There's no guessing in DCA, no predicting the bottoms, and no waiting for the perfect time. Instead of investing a lump sum all at once, you can consistently do this over time. And this is what makes it perfect if you're trading or you're starting off with a small account portfolio. Now, here's a simple example. So in month one, I'm going to go ahead, I'm going to buy, let's say, $50 of Meta, and that's going to allow me to buy a certain amount of shares. Now, month two, the price is going to go down. So I'm going to invest the same $50, but this time I'm going to be able to buy even more shares. In month three now, let's say Meta price goes up, I'm still going to invest $50. However, my $50 will now only be able to buy less than what I was able to buy when the market was dropped. So that's the simplistic nature right there. You invest $50, that's it. The next month the price drops, you invest the same $50, which is going to buy you more shares. The next month the price goes up, you're going to invest the same $50, which is going to allow you to buy less shares. Over time, you end up with more shares at lower prices and fewer shares at higher prices, which helps smooth out any volatility. You're not trying to be perfect, you're trying to be consistent. And consistency beats perfection every single time. Now, why do most beginners fail at investing? Here's the truth most people won't tell you, but I will. Most beginners don't fail because they pick bad stocks, they fail because they let emotions control their decisions. Let's talk about the two biggest emotional mistakes. Number one, the biggest one is going to be fear. The market drops 10%, headlines scream, crash. Social media says, sell everything. OMG, it's so overwhelming. So, during the course of all of this, beginners panic and they sell, and that's when they lock in losses. The other big failure for new investors is going to be greed. The market is at all time highs, so everyone is posting gains. Stocks feel safe again. So, what do beginners do? They pile in right before there's a pullback. This cycle repeats over and over. So, dollar cost average removes any emotion from investing. You're not reacting, you're not guessing, you're executing a plan. That is it. So one of your questions might be, why does dollar cost averaging works as opposed to so many other investing strategies out there? Well, dollar cost average works for three powerful reasons. One, it eliminates market timing. Market timing sounds great in theory. I'll buy at the bottom, I'll sell at the top. But even professional fund managers struggle to do this consistently. What DCA says is that it says I don't care about short-term moves, I care about long-term growth, and historically long-term investing wins all the time. Now, the next reason why dollar cost averaging works is that you automatically buy more when prices are low. When prices drop, your fixed investment buys more shares. This lowers your average cost per share over time, and that's the key advantage of the DCA model. Instead of fearing dips, you start to welcome them. And even third reason why dollar cost averaging works is that it builds discipline above all else. Investing isn't about intelligence, it's about behavior. Dollar cost averaging builds a habit. It encourages patience, which is needed in order for you to grow in the stock market, and it keeps you invested even during bad markets. And those who stay invested are the ones who will win long term. And with this portfolio, my goal is to show you how staying in the market over time is going to allow me to grow this portfolio. Another question that beginners ask is that why do you use dollar cost averaging as opposed to just investing a lump sum? So I'm going to address that. Mathematically speaking, yes, lump sum investing can work out. If you invest a lump sum at the perfect time, you'll completely outperform the DCA model. But here's the problem, you don't know the perfect time. Most people hesitate, they wait, they second guess, and while they wait, the market moves without them. Dollar cost averaging is often better for real humans like me and you, not theoretical ones that cannot make a decision, because it helps you to start investing sooner rather than later. It helps you stay invested longer, which is going to create more consistency, and it makes you avoid regret. The best strategy is the one that you can stick to, hence consistency. Now, what can you dollar cost average into? Well, pretty much almost everything. You can dollar cost average into almost any asset. I'm going to show you three assets that you can use in order to dollar cost average. The number one is going to be into individual stocks. DCA works perfect with individual stocks. It's great for long-term growth on high quality companies. Some examples of stocks and ETF that you could use in order to use a DCA model is going to be Amazon, Microsoft, Netflix, Apple, even the Spider ETF, which I'm going to get into later. And you could see them here. That's going to be the top four, which is going to be Meta, Microsoft, Amazon, Google. I think these stocks are perfect in order to implement the DCA model. Now, another another asset that can be used in order to implement the DCA model is going to be on ETF. ETF stands for electronic traded funds. ETFs gives you instant diversification. Now, I'm a stock picker because I've been doing this for quite a while, so I don't need to rely on a exchange traded fund on ETF. If you are a beginner investor, however, I highly advise that you get started with your DCA model with an ETF. And I'm going to give you two ETFs which can help. One is going to be VTI, which helps you out with the perfect diversification into the world market, and also SCHD. I do have SCHD as my foundation in one of my bigger accounts portfolio, and this one is also going to be a dividend payer, and we're going to get into dividends as the channel goes along. Now, a third asset that can be used for the DCA model, which is extremely risky, is going to be options trading. You could go ahead and dollar cost your way average into options contract if you gone ahead and you did your own due diligence and you know what your expected result is going to be. We're going to cover options trading later on this channel. That leads me to the natural next question, which is going to be how much should you dollar cost average? Here's the good news. You don't need a lot of money, like I showed you. You can start with $10 a week, $25 per paycheck, or even $100 per month. It does not matter. What matters is that you get started. The amount matters far less than consistency does. Here's a simple rule. Invest what you can afford to never touch for years. So if you're stressed out about the amount, simple rule of thumb, it's too much. So the next obvious question is going to be how often should I dollar cost average? Well, stick to a schedule. Common schedule is going to be weekly, bi-weekly, which is going to be aligned with your paychecks or whenever you have money coming in, or what I use on this channel, which is going to be monthly. There's no perfect frequency. The best one is the one that fits your income and lifestyle. Automation is your best friend here. Take my word for it. Now, speaking of automation, automation is where the DCA model becomes very powerful. Most brokerages allow you to set up recurring investments, like I've showed you on this channel. It allows you to automatically invest in ETFs and stocks, and most importantly, it allows you to invest without even thinking about it. Automation removes laziness, it removes fear, and it removes you emotionally making decisions. You set it once and you let it run. Hence, I love to call the DCA model the set it and the forget it model. Now let's go ahead and jump into some common mistakes that can be done with dollar cost averaging. Let's avoid these beginner mistakes. Number one is going to be stopping when the market drops. Whenever the market decides to go down, that's when most beginner investors decide to stop dollar cost averaging because they think they're going to be losing. This defeats the whole purpose of the DCA model. The market drops are when DCA models work the best because you are able now to receive much value for the stocks that you have high conviction on. Now, a second mistake that's made is that you go ahead and you chase hype stocks. Dollar cost averaging works best with stocks that have strong fundamentals. And like I said, if you are not a stock picker, then go ahead and choose any one of the stocks in the Max 7 or a couple of them, or choose stocks in the S&P 500. Dollar cost averaging also allows you to get exposure to the broad market. Like I mentioned, I gave you two ETF that can be used, which was VTI and SCHD. Of course, this is not financial advice. This is just two ETFs that can help you get started on your journey using dollar cost averaging. Now, the third and one of the most common mistakes is that you expect fast results. DCA is not a get rich quick strategy. It's a get wealthy slowly strategy, but get wealthy nonetheless. Now, you need to set realistic expectations. Dollar cost averaging won't make you rich overnight, but around over 10 years, maybe over 20 years, and even better, anything over 30 years, you're gonna start seeing results. Dollar cost averaging can completely change your financial future. Small amounts, consistent investing, long term horizon. That's the perfect formula right there. Now, I'm not going to lie to you. One of the hardest time to dollar cost average is during market crashes. Market crashes can feel scary, especially if you are new to the stock market. But for DCA investors, there what's known as opportunities. These are opportunities for us because when price drops, your money is going to buy more shares. Your future returns are going to be even better because you're buying the present price, which is going to be lower because of the market crash. And as the share price goes up, then you're going to see exponential growth, exponential gains. The market has always recovered historically. Those who keep invested even during the downturns are usually the ones that are well rewarded. And we have seen this time and time again. History always keeps repeating itself. Now, who should be using dollar cost averaging? Dollar cost averaging is going to be perfect for the most important beginners. Number two, busy professionals, people that work a regular 9 to 5 job and they don't have time to be monitoring the stock market. Number three is going to be long term investors. The longer horizon you have in order for you to stay invested in the market, the better it's going to work out for you using the DCA model. And most importantly, anyone who absolutely does not like being stressed out. Dollar cost average takes out all the stress by putting your investing on automation. You don't have to worry about anything. You don't have to be stressed out about anything. If you want simple, disciplined investing, then DCA is for you. So I know after all of that, you're going to be asking yourself, how do I get started? So here's how. Open a brokerage account today. In order for you to go ahead and start investing and using the DCA model, you're going to need a brokerage account. I will put a couple links in the description below of some brokerage account that I actually use, including Robinhood, which is the one I'm using to make this video right now. Now, the next thing you're going to do, you're going to choose 1 to 3 investments. And if you are completely new to investing, I highly recommend using ETFs. Next, you're going to go ahead, you're going to pick a dollar amount that you're comfortable with, and you're going to be comfortable sending that same amount consistently over time. Next, you're going to choose a schedule. Choose a schedule that works for you. Weekly, bi-weekly, monthly, quarterly, it does not matter. It has to work for you. If it does not work for you, you will not be in it for the long term. The most important step is going to be to automate it. Make sure you put it on autopilot so you do not have to worry about it. And here is one of the most important things that most people forget to mention. Whenever you go ahead and you do all of that, the last part, the most important part is going to be for you to ignore short-term noise. Whenever you are investing, whether you are doing your DCA model, you're gonna hear short-term noise. You're gonna hear noise about inflation rates. Your buddies, your friends are gonna be posting huge gains about what they're doing with um with trading, with investing, or getting into new stocks, speculative stocks. Try your best to ignore all of that. Trust me when I say, in the long run, it's all going to work out for you. You're going to be stress free, and your portfolio is going to be growing consistently over time. Now, if you made it this far, then congratulations. You're definitely interested in growing an investment account, especially using the DCA model. You now understand the most powerful investing strategy that has ever been created. Dollar cost averaging is not flashy. It isn't exciting, but it works. As you can see, I only have $326 in this account, and I'm going to be adding just $250 on a monthly basis. $250 everyone can afford, which is going to work out to be $62.50 on a weekly basis. So this is definitely not sexy, but it works. Now, if this video has helped you, remember, like the video, subscribe for more beginner-friendly investing content, especially if you want to stay in the market for the long term, and comment DCA if you plan to start today. And remember, the best time to invest was years ago. The second best time is going to be right now. Now, for those of you guys who made it to the end of the video, I know you guys are committed to investing, to using a strategy such as the DCA model and growing that investment over time. My job here, I believe, is very simple. My job right now is to give you as much content, as much information that I can possibly do in order for you to be able to help push your investments.